Hey folks, so in this video, I just wanted to talk about the current situation that we're in. So earlier today, I was talking about the Fed funds rate and where we're going to be based off the FOMC projections. But, I didn't really mention inflation. So, the Fed, they're targeting 2% inflation. But if we're looking at this chart right here, they're not expecting that until 2025. And even in 2025, it's not even 2%. It's very close to that. So keep in mind, this information is actually the accumulated projections of the 7 Board of Governors and the 12 district bank presidents. So this is where they think we're going to be in these time frames. So that essentially means that inflation is proving to be much stickier than they had thought. So let's just go ahead and let's look at the next point. So if we're looking at this, right now we're currently at 3% to 3.25% on the Fed funds rate. Now, the next meeting, we're going to see another rate hike. That's on November 2nd. They're expecting 75 basis points again. So another 0.75 rate hike. So they're expecting a 70.5% chance that this is going to happen. Now, obviously, this can change with inflation data, but if we're looking at the economic projections right here, we're looking at the Fed funds rate being around 4.4% by 2022. So it could be very likely that we see another 75 basis point rate hike. Now, let's just go ahead, take a look at the FOMC calendar. Now, we have that November meeting, like I just said, and then we have another meeting after that. That is December the 14th when we get that next interest rate hike. So this will be the final meeting of the year. And this is another big one. We're essentially going to get another economic projections in December 14th. So we're going to get another one of these guys. And basically all the Fed presidents, all the Fed bank presidents and the Board of Governors, they're going to tell us what their thoughts are again for 2023, 2024, 2025, 2026, and the longer run. So let's just go ahead and look at some other data points here. Now, I wanted to look at the 30-year fixed mortgage. So if we're looking right here, it's at 6.02%. It has not been here since the great financial crisis here in 2008. So mortgage rates, they're really high right now. And let's just take a look at this right here. So this is the National Association of Realtors Housing Affordability Index. So if we're looking at the most recent data point, let me just zoom in a little bit for you guys. So if we're looking at median priced existing single family homes in July, it was $410,600. So, mortgage rates here were 5.48%. So this is obviously lagging data, but it's still pretty important. Now, if we're looking at the monthly principal and interest payments, so just to give you guys full information, we are basing this off of a 20% down payment with these mortgage rates. So the monthly principal and interest payments would be $1,861. Now, if we're looking at median family income, that is $91,304. So if we go ahead and we annualize this number, which I can do right now, so that's $1,861. Multiply that by 12. So here we have it annualized. Now we're just going to go ahead and divide it by the median family income. And then we're going to multiply by 100 to give us a percentage. So here we can see it's about 24.46. So they went ahead and rounded that right here. So why is this number important? Well, most banks, they don't really want to give out these loans unless people are making enough money so that their principal and interest payments are less than 25% of their total income. So as you guys saw in that calculation, it's about 24.5%. So now we have this thing, it's called the Affordability Index. So the affordability index is basically a ratio looking at the qualifying income to get a loan versus the median family income. So I'll show you how this is calculated. So we essentially get the median family income, which is 91,304. And then we're going to go ahead and divide that by 89,328. And then we're going to multiply by 100. So this actually gives us an index number of 102.2. So you guys can see that in June, this was actually under 100. So what this means is that qualifying income to get a loan was higher than median family income, which means that this is very unaffordable and more people are unable to get loans. So if more people are unable to get loans, what this essentially means is that it's going to be harder to sell these homes because you have less buyers. And naturally what happens is that, the housing price should go down. Also keep in mind, winter is coming. So we could see home prices drop significantly. Now, I do want to show you guys how this is calculated. So what I'm going to do right here is I'm going to go ahead and show you guys this calculation. So we're going to take 410,000 and $600, and then we are going to multiply that by 0.8. And this is because we put a 20% down payment. Now I'm going to plug this information into a mortgage calculator. So we're going to go ahead, we're going to copy this information right here. And then 5.48 is the mortgage rate. So now look at that, $1,861 is our monthly payment. What do you know, $1,861. So there you go, I proved that to you guys on how this is calculated. So now let's go ahead and let's move on to the next topic. So we're looking at the United States 2-year Treasury. This is at 4.129%. Now, this is important because a lot of stocks that claim to be high dividend stocks on the stock market are not even providing yields that are close to this. So, that tells me that there's a lot more selling to do in the equity side, because in the debt market, we're seeing rates that are offering 4.13% for a 2-year Treasury, and this is risk-free, you guys. So, when these treasuries, when they mature, and let's say the United States, they don't have enough money to pay this. Well, what are they going to do? They're just going to print some more money, and it's not going to be a problem. That is why they call it a risk-free rate, because essentially, you're getting these yields and there's really no risk to it. Whereas if you're getting corporate bonds or you're investing in equities, there's a ton of risk to that because they could default. And these companies, they can't just print money out of thin air. That is why they call these risk-free yields. So I hope you guys enjoyed this video, and I hope you guys definitely understood what kind of situation we're actually in. So have a great one, you guys.